Hi everybody, this is Sahaba and Giacomo, and today I'm with a special guest. She's Anna Sokolidou. She's a contributor for Seeking Alpha, and today she's going to talk about Tesla and Tesla stock. So Anna, feel free to introduce yourself, and let's get into the content.
All right, thank you so much. My name is Anna. Nice to meet you all. Today we're going to talk about asset bubbles, and Tesla as just an example of today's asset bubbles. Certainly, asset bubbles have happened before, and we'll do a recap of some notable asset bubbles in history, including the tulip mania, the South Sea Company bubble, the dot-com bubble, of course, and I'll also explain why Tesla is just one of such bubbles. So basically, what is an asset bubble? An asset bubble occurs when the price of an asset, such as stocks, bonds, real estate, or commodities, basically any other asset, rises at a rapid pace without underlying fundamentals to justify the price spike. This is a definition borrowed from Investopedia. So it means that if an asset class, any asset class whatsoever, rises dramatically so that it doesn't meet technicals and it doesn't quite correspond to the price rise, it is a problem for investors. And you might ask, why is that? It's a good piece of news when an asset class rises dramatically. All the investors that have bought this particular asset make plenty of gains. Basically, nothing to worry about. Everything is good and running and rising. But eventually, as time passes, such asset classes fall in value quite big. Because if there are no justifying fundamentals, and if an asset shouldn't trade for the price it is trading for, then eventually the price should meet the underlying fundamentals. Because if you invest for the long term. You do not speculate when you invest. Speculators can be well off when they invest for the short term and if they have plenty of luck. But most people like you and I are not such people. And it is really hard to get the timing right if you speculate. And if you see that a particular stock or bond or commodity or a house isn't worth its money, then you should stay away from this. I hope everyone understands this, but history shows that most people don't understand this, or they can understand it in principle, but when it comes to them personally, to their investing and to their opportunities to make big money, then they can simply forget this and lose plenty of capital. Well, here are just a few examples of famous asset bubbles. The first one, the first well-known one, at least in Europe, was the famous tulip mania in the 17th century Netherlands. I'm sure everyone knows that black tulips were really precious flowers at the time in Holland. And other rare tulips were worth quite a lot. Basically, a single tulip bulb was worth as much as a good sound house in Amsterdam, plenty of money, and the first ever stock exchange where people came to buy and sell stocks, commodities, derivatives, that is, was the famous stock exchange of Amsterdam. In this, at the time in the 17th century, by the way, it was founded in the 17th century. So basically, everyone rushed, many traders, speculators, and the general public rushed to this famous stock exchange in Amsterdam to buy the precious tulip bulbs. But this too shall pass. All passes, and this too shall pass. Basically, the tulip frenzy ended like most acid bubbles. The flowers depreciated substantially in value, and all the investors' interest decreased substantially as well. So the poor people that bought a single tulip bulb for their houses, lost their fortunes. They went bankrupt, and the same happened. A similar story happened during the famous South Sea Company bubble. It was in the 18th century, and British colonies were really popular, and one really large company, almost a monopoly, traded with the overseas colonies. And it was the so-called South Sea Company in the 18th century. It was quite a frenzy, everyone got mad in order to invest into this company's stock. You might think that only stupid or uneducated people rushed to buy these stocks. No, even the famous Isaac Newton also invested in this company. You see, even if you are a renowned scientist, it won't necessarily protect you from making the same mistake. In fact, Mr. Newton bought into this bubble when it was rising. Then he got rid of his stake, but the stock still kept rising, and still everyone kept buying the stock. So what would you think Mr. Newton did? He invested into this company again, and the company was didn't only go bankrupt, it was fraud. In other words, the directors at the time lied to the investors, and it was all fraudulent misrepresentation, so to speak, and everyone lost big. In some cases, some asset bubbles are fraud. In other words, the directors, the management lie to the investors or to their shareholders, or in some cases, it is not fraud, just the investors don't quite notice the obvious, including a particular company's assets, its debt, its profits, its revenues, and its future, and obviously its valuations. But we'll talk about this a little bit later. Another crisis was Japan's real estate crisis in the 1980s. There were plenty of crises since the South Sea Company bubble, but I'll just touch a few of the most recent ones. So, have you heard of the term Japanification? It happens basically when a country's economies, when a country's economy is keeps decreasing the interest rates, the asset valuations keep rising, there is no real GDP growth, whilst there is also deflation. A lot of economists have mentioned that in many developed countries, the story similar to Japan is happening. Basically, there is low inflation, not now, but in many countries are experiencing a very similar story. But Japan's real estate prices have been rising until 1992. So basically the crisis happened between 1986 and 1992 when it burst, when the asset bubble burst. The stock prices also kept rising. The interest rates were negative and kept decreasing. Everyone rushed to invest, but the fundamentals didn't quite meet the technicals. And eventually, the prices, including the stock prices, fell down dramatically when a crisis happened, and when there was also a recession in Japan. But the dot-com bubble is probably the most famous asset bubble and also quite similar to the one happening today. What I mean by this is that the high-tech sectors used to be very popular at the time. The internet companies, the computer makers became very popular among the general public. Everyone kept buying the stocks just because the companies that made them available for sale had something to do with the internet, with the high-tech sector, and also with laptops and computers. So the bubble that burst in 2003 started in the 1990s. It was quite a good time for the Silicon Valley because it is still the place of innovations, but it was particularly popular and strong at the time. The computer technologies really kept on developing, and some companies started operating that had plenty of debt, were loss-making, and only had quite strong revenue growth. But because they had something to do with the new technologies, and the management claimed there was plenty of growth potential in this market, everyone started buying these companies' stocks. And some of these companies, many of these companies, in fact, went bankrupt. Some went bankrupt because they didn't manage to reach profitability. Others struggled with too much debt. Noteworthy is also that the interest rates were quite low at the time, and they only started rising in the beginning of the 2000s, in 2001, 2003, and then there was a brief recession. Many companies went bankrupt when the interest rates started rising, and the poor investors lost plenty of money as well. And the 2008-2009 Great Recession, everyone knows, and it was also a real estate crisis, and also the financial sector struggled. In fact, it was also a debt crisis in a way, because many loans were given to individuals and also to some businesses that were unable to repay them. And also, there were not just physical houses or apartments that bought for very high prices. There were also plenty of real estate derivatives that were also bought at unreasonably high prices. Plus, the Fed was forced to raise the interest rates. In fact, 2007, 2008 these years were marked by quite high interest rates. And it is really hard to service the debt when the interest rates are high. Obviously, the companies, the businesses, the real estate developers struggled. The general public, the people who took mortgages for very high house prices in order to be able to afford very expensive houses, all started struggling, and the US government had to bail some financial companies and all the big banks out. But what is happening now? Actually, I think that the situation is quite similar to the 2008-2009 financial crisis, since the interest rates are really high. In fact, they are higher than they were in 2008. And it is still unclear when the Fed would eventually decrease the interest rates. And the situation is also similar to the dot-com bubble. By this, I mean that the high-tech sector is extremely popular right now. All the NASDAQ, or most of the NASDAQ companies, are doing extremely well in terms of their stock prices. And everyone is far too enthusiastic, and it seems that everyone expects the soft landing. But let me give you some more details of the most expensive high-tech companies. Okay, Tesla, AMD, NVIDIA, Zoom, and all this. So I've just mentioned the most expensive NASDAQ companies. Why are they so expensive? What is wrong with their valuations? Well, they have sky-high price-to-earnings ratios, absolutely incredibly high price-to-book ratios. In fact, some of these companies' P/B ratios are 20, 30, 40, and in some cases these are even higher. These companies have no tangible book values whatsoever, or they have negative tangible book values. In other words, they have their physical assets are not, their real assets are not supported by their liabilities. I mean, their liabilities are not supported by their real assets. Most of the balance sheets, most of these companies' balance sheets also rely on their licenses, on their other intangible assets, including copyright, including their reputations, and investors' enthusiasm. Okay, all of these businesses are high-tech, glamorous high-tech businesses. In other words, the investors are really in love with the brands. Who doesn't know Tesla? Who doesn't know Elon Musk? Who does not believe in Zoom? By the way, we're recording this video in Zoom. And who everyone knows the high-tech sector needs microchips, and so they need AMD and NVIDIA. But the problem is that investors are willing to overpay for this. Even if you start talking to this or chatting with these investors, you will see that they are quite aggressive and they are overconfident their favorite companies will do extremely well in the future, and the sky high valuations justify the fundamentals. Even some of the poor pieces of news are ignored by the general market. Even if there is a profit slowdown, if the sales are struggling, if nothing is rising, even if the macroeconomic outlook is getting horrible, their stock prices are normally rising, or at least are not falling, or which means the general public doesn't really care about the fundamentals. And these companies' managements also tend to be extremely optimistic. They promise a lot to the investors. For example, they say that such and such a company will come up with an impressive innovation. It will become the market's leader. All of its competitors will get out of business. Such and such a company will get China's market share. In other words, the promises are really impressive, but these sky-high expectations are not usually met. And even if the interest rates are high, some of the companies are not doing an extremely good job in paying back their debt. By the way, I do not say that the companies I've just mentioned in the title of this slide will run out of business. No. But they can service their debt, but still the coming recession will change a lot for their businesses and for their fundamentals. But no one sees this. Everyone is far too optimistic. Okay, now let's finally talk about Tesla. Tesla's shares are overpriced, and we are now looking at weakness ahead. In two words, yes, the price to earnings ratio is really high, the price to sales ratio is sky high, the price to B ratio is also unreasonable, and also the price to free cash flow ratio is also horrible. At the same time, Tesla faces a challenging consumer market. By the way, the first 2 points are borrowed from Seeking Alpha's analysts. These are not my own quotes, so I'll just give credit to Seeking Alpha for these 2 first points. So Tesla faces a challenging consumer market as global economic growth slows, obviously, because it sells electric vehicles. And when the consumer market is contracting, when there is a recession, no one rushes to buy cars. Well, some people might do so, but they would rather go for cheaper models, not so premium class, or maybe even second-hand cars. Would you during economic hardships? Also, although Tesla dominates in the US, it is mostly a US company. It still relies on China's market. Whilst China's EV makers are doing quite a good job, the Chinese government would rather support its national automakers, and these companies grow quite well. I mean, by this I mean that their market shares grow quite well. And at the same time, Tesla, China is facing a recession, especially the real estate crisis, and is not experiencing a very good and growing consumer market. Also, just in spite of the numerous price discounts, Tesla is still struggling to sell a lot of its EVs in the US. In fact, it has made a record number of price cuts, and still it is struggling to meet its sales targets. Not to mention that the price cuts are really problematic for the company's profit margins. Obviously, the margins may contract through 2024 and result in significantly lower free cash flow. Obviously, this will be bad for the company's cash position, although in the recent few years, Tesla has reduced its debt, and also the leading credit rating agencies have also increased the EV makers' credit rating, but still lower cash levels are not really good for a company like Tesla. Also, most of the enthusiasm is driven by the management's promises. A lot of Tesla's bulls, if you have a chat with them, say that Elon Musk will eventually launch fully autonomous self-driving for its cars. Also, they would also say that Cybertrucks are really good and profitable products. They would also say that Tesla will become the world's leader in the field of artificial intelligence. But all these promises made by Elon Musk do not quite correspond to the real facts. So, but instead of getting disappointed, lots of people do not quite notice this. They still stay invested in Tesla shares, and some of the newbies also buy Tesla stock because some analysts also recommend buying Tesla stock on any minor weakness, which in my view isn't a really good idea, especially now when the S&P 500 is is near record highs, and everyone expects soft landing of the US economy. And of course, some people prefer Tesla because they are fans of Elon Musk. But do not forget that the competition is high and rising, especially in China, as I've mentioned before, and many classical automakers also produce EVs, including Mercedes, including Volkswagen, including Honda, including plenty of other companies' name, and of course, including General Motors. All these companies have already started producing EVs. So there is also plenty of competition from other automakers, not just EV makers. So Tesla isn't a monopolist. In other words, it doesn't have an absolute advantage. And not to mention that the industry it operates in is struggling because of the coming crisis, because of the uh, low manufacturing indices, because of the low GDP growth, because of the high interest rates. Yes, a lot of people also borrow in order to buy a car or any EV. In other words, they do not use their own money, so their demand is quite weak these days because of the high interest rates. Also, you might say that other revenue sources, including solar batteries, can help Tesla, but they are accountable for only a very small portion of Tesla's sales, and they are not showing very good profit as well. So, I would, before buying such companies like Tesla, I would recommend investors to check the fundamentals twice and also not forget the valuations. So before buying a company that you really like, that you think has a bright future, ask yourself, how much does it cost? Okay, thank you very much. I enjoyed chatting with you. Have a great day.
Okay. So one question that I have is, don't you think that Tesla could follow the same path that Amazon had? Like Amazon has been not making money for almost 10 years, and all of a sudden it went profitable and then it exploded basically. Don't you think it's at that stage that is profitable but not too much?
Well, yes, I can perfectly understand you. It is possible, of course. Everything is possible, but Amazon emerged during the dot-com bubble, basically. It was founded in the 1990s when everyone was crazy about internet companies. And yes, of course, it is possible Tesla would follow um, Amazon's route, and it can it can eventually start plenty of making plenty of money, and its valuations can stay high, and in fact its stock price can keep exploding for ages, the way it happened to Amazon. But Amazon was one of the few companies that managed to succeed this way. But most of the companies that were founded in the 1990s operating in the high-tech sector either went bankrupt or started trading for very little money. Yes, many companies stayed afloat, but didn't make plenty of money for their shareholders. So there are upside risks, to be sure, and I wouldn't be surprised if Tesla would repeat the fate of Amazon, but in my view, it is an overvalued company that has got too much of investors' attention.
Okay, okay, I understand. And regarding um, the the multiples that you have talked about, don't you think, what do you make of the expected rate cuts that people are expecting for by mid or by the end of the year? Is it reasonable to expect these kind of rate cuts and as a consequence have higher ratios, or you think it's overrated?
Yes, it is possible, of course, that Jay Powell would reduce the interest rates in the middle of this year or at the end of this year, but there are also risks that he wouldn't do this simply because the unemployment rate is really low. In fact, it is comparable to the unemployment rate that we had in 2019. That is before the pandemic. The inflation numbers are getting better, but the 2% inflation target is still not quite met. In other words, the inflation rate, the CPI index, I mean, is over 3%. So it is possible there will be no soft landing. In other words, the Fed would react far too late. Do you remember in 2023, in the beginning of 2023, there was a small banking crisis.
Yeah.
But it was stopped by the Fed. In other words, there were a few bailouts even, but in other words, the Fed and the Treasury reacted quite fast. But there is a risk they would be late to intervene. Because it would be enough for Jay Powell to just hold a conference and say that that the US economy is doing well and there are no reasons to worry and no rate cuts will be made. Even if Powell doesn't raise the interest rates, still the market can overreact. The yields can rise dramatically, and everyone will can start panicking. And I mean, it is the worst situation ever when the market panics.
Okay, I understand your point of view. So thank you for your availability. I'm done with the questions. Thank you for taking the time, and yeah, see you next time.
The pleasure was all mine. Have a great day. Thanks.
Okay, so if you want to read Anna's articles on Seeking Alpha, I'll put the link in the description so you can find them over there. So this is it for today. I'm Giacomo. This is Asahab. See you next time.
See you. Bye.